We have a gentleman who actually, well, all you guys do this for a living, but he's got to live by what he says because he's head of equity strategy for Wells Fargo Securities. Chris Harvey, do you echo what you're hearing from us here, or what do you think?
So, Joe, I do echo a fair amount of what I'm hearing. So I think it is a healthy correction. I think it was long overdue. There's a lot of talk about a second wave. I really don't think that's what it was. I think it was very much Fed-related. If the Fed is going to tell you that we're going to keep rates lower for longer and longer and longer, two things are going to happen, and we're beginning to see both. One, that negative interest rate narrative or commentary is going to come back, and that's not good for risk product. That's not good for sentiment. That's not good for the economy. And the second thing it's going to do, which it began to do, it's going to flatten the yield curve. And the same thing there. Bad for risk product, bad for the economy, bad for sentiment. But I really do think this is more of a 10% pullback than anything else because the underlying fundamentals are slowly improving. The credit markets are wide open. Credit is widely available. And we just went too far too fast. I think things probably trade sloppy up until Fed stress tests or maybe even to Q2 earnings. But eventually they'll start to work themselves out because I think the commentary, though the numbers will be very difficult in 2Q, will be rather constructive, where the C-suite says, hey, May was better than April, June was better than May, and July, not so bad. And I think we can rally on that, and I think that's what we need to look forward to.
Chris, it's interesting you ascribe more of it to the Fed than to the worries about the pandemic. I asked Jim Grant this morning whether ever comes the day where the Fed is actually part of the problem for what's happening instead of the solution. We all think the Fed's done a great job. We love the Fed, all the liquidity. But guys like Jim Grant think we're never getting out of this, that the size of the balance sheet at this point and the central banks around the world and negative rates and beggar thy neighbor and everything else, that he actually thinks that the Fed is part of the problem with what's happening in the market, not the solution. Do you think that?
So the Fed did a great job back in March, and they did a great job with a lot of the facilities, especially the credit facilities. But I will point out that, to the best of my knowledge, that the Fed hasn't purchased a single corporate bond. But getting back to the point, the issue with yesterday and the issue I have with the Fed is they keep saying or thinking that lower rates are the solution, and that's not the solution anymore. And to your point, there's a lot of things the Fed didn't do right. I think what the Fed did for many years is they provided too much liquidity. They kept the creative destructive process from happening, too much capacity, so we never had pricing power, we didn't have inflation, and they were part of the problem. So I take the good with the bad. They've done some really great things, but some of the things that they're doing, I think they need to work on some of their communication, and I think they need to really understand better what they're communicating to the bond market, to the yield curve, and to investors. Because lower rates are not always a solution, and I don't think that's the solution right here, right now.
Because there is a vocal group of people that you see it, on the internet and elsewhere about central banks and the Fed and everything else. And I'm just wondering, everybody's saying, yeah, the Fed did it today, but they did it just because of their economic take on what's happening, not because of what they actually did. Anyway, Chris, thank you. Guy, what do you think? On what Chris said and just on the notion that there could be, I don't know when, I mean, inflation doesn't seem bad, but there could be a day of reckoning someday for the Fed?
Yeah, it's interesting. I mean, I've sort of come down on the other side of that. I'm on sort of the Jim Grant side where I think the Fed is more part of the problem. But I can understand if you're just looking through the prism of the market. I mean, the Fed's been unbelievable for the market, and I get the wealth effect that creates. I mean, I can understand that argument, but broader looking, I think the Fed has gone down a rabbit hole, to your point, that they're never going to be able to extricate themselves from, which is problematic. I don't know when that's problematic. I think, again, to Chris's point, they've put in a bit of a buffer where the credit markets are not going to have that exogenous event like we saw in March. I think that's positive. And I do think you have to start looking for levels where you want to get back into some of these names. They've moved so quickly. The banks, for example, and I think Dan Nathan has done a really good job with these. I mean, J.P. Morgan, for example, got to 115. We had talked about 115 as a level just in terms of the metric of a $62 tangible book, a 1.8 multiple on that. Gets you 115, and it did exactly that. Now I think, again, and I think Karen would agree with this, you're looking for levels to get back in to these names.
Okay. We'll talk more about that. I think we're, Karen, I would have maybe gone to you or Tim or Steve. I'm just reading, and it said Guy. Ask Guy what he thinks. I don't know who made Guy.
Doing a great job, Joe.
I don't know who made Guy king, although that's a
No, that's fine.
that's a beautiful back. He's got all right.
He is king.